Hey there, listeners, and welcome to the Dairy Monday Market Watch. This podcast is put on by Cornell Cooperative Extension's North Country Regional Ag Team. I'll be your host. My name is Kelsey O'Shea, and I'm the Farm Business Management Specialist here in Northern New York. Each week, we're going to talk with a market specialist about what's happened over the past week, what's coming up ahead, and how these events may impact your business. So be sure to stay tuned and check back with us each Monday. If you're not already, make sure you follow our YouTube channel. We are CCE North Country Regional Ag Team, or follow us on Facebook to see these updates. This week, our market specialist will be Anup Singh.
Thank you. Thank you for having me. So my background is, my name is Anup. I am married into dairy. I met my beautiful wife in Houston, where I was working in the energy business. So was she. And her parents are dairy farmers in Vermont.
Today, we're going to be talking about the market events of the last few days, which includes the dairy markets limiting up, the exact opposite of what it was doing just a couple short weeks ago. So Anup, can you help us start to understand what's going on to encourage this sort of price behavior?
The first observation is, looking from outside into the market is end of March, market limit down 3-4 days in a row, and we gave up average, let's say from a 16.50-ish milk price to 10.50 milk price. So we gave up roughly $5.50-$6 in a very short period of time. And then the prices remained at this low bound, low end up until 2 weeks ago. And then 2 weeks ago, starting 2 weeks ago, we saw this really constructive bound up. And that bound up was now 4 to 6 days of limit ups. Like even today, the June contract is limit up. So looking from the outside in, one could very quickly say this is such a volatile, immature market. That's right. One thing you can walk away with, right? Mm-hmm. Second thing one could also walk away with is, why is this a sign of market being completely distorted?
Yeah.
Right? Is there a lot of speculative money flow in and out of the market? Right? That's another thing one could draw a conclusion from, right? The third observation one could make is, what is the volume that's driving all this? Right? Because one common criticism that I have heard a lot for the CME cash market is, one lot being sold could drop the market and impact farmers, payout. Mm-hmm. So you could put that into context as well. So let's just take through that and let's explain what's happening in the market, and what part of this did we predict would happen. So recall that when we initially started these podcasts, the first podcast, I said that while I had expected some downside, I had not expected the violence with which the price moved down. Right. So the magnitude of the downside and the speed with which the prices fell, I had not anticipated, at the end of January, when I started thinking about how severe or what would be the severity of, the pandemic and its impact on demand and economy. Now, the size of the upside, on the contrary, was not surprising. So first off, let's think in terms of the price going down. So if we think in terms of the futures market, so first off, my first line of reasoning, or my first line of presentation, is that this market is a very mature market, meaning that this market is where what you're seeing limit downs and limit ups is the ability of the market participants to express themselves and express their concern.
Okay.
So what does that mean? In any transaction, there's a buyer and a seller.
Right.
Right? And as if the buyer and seller are rational, meaning you are the buyer, I'm the seller, and we can agree on the price doesn't move much, right?
True.
I offered to sell at 16, you offered to buy at 15, we'll negotiate, and let's say we settle at 15.50. And when there is when the buying and selling demand supply is balanced, the price moves gradually in either directions. And it adjusts for changes in the perceptions of demand supply as days progress and more information becomes available. So what happens when the market limits down? Well, when the market limits down, there's a seller. You are selling $16 milk, class 3. I'm the buyer. And I'm basically saying that I do not know, or I don't have a line of sight on demand, and there's great deal of uncertainty. I'm unable to buy at $16. And by the way, since I'm unable to buy at $16, I have no idea what price can I buy at.
Right.
So now so I made a very rational point of view and said, look, I don't have a line of sight on demand, hence I can't even make you an offer or what price I'm willing to pay. That makes the seller emotional
Mm.
because the seller is sitting on inventory that needs to get converted to cash for whatever reason.
Right.
So the seller then starts to drop its price, and the price then drops as far it has to drop until the buyer feels comfortable. Okay, even given the uncertainty, at these prices, I'm happy to take the risk of taking product from Kelsey to me.
Okay.
That's where the market limits down, is the buyer doesn't have a line of sight of demand,
Right.
right? Now, you flip that on the other side, is now Kelsey sold to me when the market was really bad. Not only did you sell what you had, you probably also forward contracted with whoever was willing to forward contract with you the end of March, early April. So what forward contracting means is you forward sold your production, let's say month of June and July, right? For because whatever reason, the production was good, not just milk, but commodities. And a lot of this is driven by commodities, not milk. So the forward selling of cheese was done. Hey, let's just not only sell what we have in storage, can we also sell projected production for the month of April, May, June, just in case we're getting a good price, let's just sell it. Yep.
Right.
Now, any new buyer comes to the market, calls you up, doesn't find product, not because you don't have product, but you've already forward sold it. So while there is product visible in the warehouse, it's not available for sale. So what does the buyer do? Well, the buyer goes and starts bidding in the market, and the price goes up until it has to go up to find a seller. Now, the seller very well could be you, Kelsey. You sold to me when the market was 13,
Right.
but if the price went up to 18, you may be happy to completely take on, default on the obligation to sell to me at 13 and you sell to the market at 18. Or at 18, me who bought at 13 from you to use the product in my own supply demand channel decides to forego selling in my own channel because the price in the market is so good that I sell what I bought from you at $18. So the price has to move up to incentivize that action to happen. Meanwhile, nothing about the underlying supply demand changes. That's just expression of an emotional buyer or an emotional seller,
Right.
which is what we are seeing in the market.
Yeah.
So it is not irrational, it is emotional,
Mm.
right? Now, what this is also then telling us is the participants in the market, not the speculators, but the physical participants. See, when the market has had the level of uncertainty that it has in the last few months, speculators would not participate in this level of uncertainty in a market that requires a lot of knowledge to be in. You can't have a crude oil trader or a person who trades Google stock come and trade class 3 futures? Because you need to know a lot more than just, a chart and price moving up and down to buy or sell it.
Right.
Right? So the market, the inherent participants in the market are the people who are in the physical business of producing milk, converting milk to commodities, buying and selling the commodity. Now, what this also tells you to some extent is the speculative nature, or not speculative nature. Actually, speculation is a result of an action. So if the participants in the market are not actively risk managing their business, you do see these kind of moves. Because if you do not risk manage your business, either production or consumption or processing a production to conversion, in effect, you become a speculator, even though that may not have been your primary intention.
Okay.
Right? Because, if you don't buy insurance, you're exposed to the elements.
Right.
Now, if you buy insurance, you're not exposed to the element.
Yep.
Now, you could argue that if you didn't buy insurance, you are reckless.
Possibly. Yeah.
Possibly, right? But that's not what I'm saying is you appearing as reckless is a result of the fact that you did not buy insurance. But you probably did not buy insurance not because you were reckless. You probably did not buy insurance because you didn't anticipate this problem to occur.
Right.
That doesn't mean you're reckless, is what I'm trying to explain.
Okay.
Right? So lack of risk managing does not mean you're a speculator. However, the market then behaves as though the primary participants in the market are speculators. That's the difference. So I don't think there's a lot of speculative money in the market. I think it is the participants in the market were not adequately risk managed. So now let's layer in a couple of more tangible explanations. So one thing we discussed in the earlier podcast is at the end of March, I saw selling happening in all contracts all the way to first half 2021. So in other words, there was selling in the contracts 12 to 18 months forward. And when I saw that selling happening that far out, my initial, assessment of that was that these are probably some commercial businesses, like for example, some burger joints or pizza joints or whatever, who
Right.
had purchased cheese and now they saw a reduction in their demand. So they were selling off the forward, risk management that they had done. Now, probably in doing so, they probably sold off more, than what they had anticipated because their point was, well, the price is going to be so cheap, whatever little we need, we'll keep buying as the market gets cheaper. So we don't need to risk manage. So there's probably a little bit of fear of missing out, FOMO, in this buying rally as well.
Little FOMO.
Yeah, there's probably no. It's not probably. There is an element of that.
Okay.
That the consumer or the producer or the not producer, the processor had access to cheese at $10, $15, and all of a sudden, everybody thinks the same way, and everybody goes to the market to buy the deal of the century, and there isn't one. And the market then just jumps up because now the buyer has the fear of whatever little cheese they needed is not available.
Okay.
Right? Now, the problem with these when there's lack of risk management, adequate risk management within the participants in the marketplace, now that then gets exasperated with, loosely what we should call intervention risk. Is the flow of news of the government supporting the market in an already delicate situation then makes this emotional behavior of participants in the market way more volatile. So we now have a confluence of many factors in this market for all the right reasons and well-meaning people.
Right.
But the market, looking from the outside, looking at the market, you would look at it and say, what a volatile, irresponsible, reckless market.
Yes.
but it's everything but that.
Okay.
So let's take butter, for example, right? Butter is a great example of all this.
Okay.
The butter example is, I mean, butter market is just trading pure numericals, arithmetic accounting. You understand accounting. So there's butter that starts getting produced after the inventory gets drawn down starting December 1st. So the producers produce butter, they produce more than what they will sell. Whatever they don't sell goes into inventory. And the US market will build up inventory of butter all the way through the month of May, June timeframe. Now, May, June, what would happen in all years past is summer happens, recreation happens, holidays happens, vacation happens. The demand for fresh products having a lot of cream goes up, i.e. ice cream is a great example. Although
Great.
it's not in its entirety, but it's a good example. So cream that would otherwise go to butter goes to making ice cream. Cream also goes to making confectionaries, chocolates, cookies, all the above, right? So that cream is not available to butter. So the butter inventory will max May, June timeframe seasonally. And then because there is not more additional cream going into butter churning, that inventory starts to get drawn down, and it will get drawn down all the way to the month of November. Yeah.
Mm-hmm.
So as this inventory is getting built, the cost of goods sold gets augmented by whatever new production that was made and what was the cost of doing so. The weighted average cost of this inventory keeps incrementally increasing or decreasing, depending on at what price was the new layer added. So the weighted average cost of goods sold in the inventory in butter today ranges anywhere from $1.50, $1.55, round figuring sake says $1.50 to $1.80. Okay, so let's say the average of that is $1.65. The cost of storing butter when there is not enough butter in storage is roughly a penny and a half to 2 pennies a month. If there's a lot of storage, butter being put in storage, the cost of storing the butter, it goes all the way, can go up to 5 cents a month, 3 to 4 cents, 5 cents a month. Okay, so $1.65 plus 5 cents a month. So if you had to sell the butter you have in the storage today in May, in the month of September, you would add 20 cents to 165, right? 5 months of storage cost per month.
Right.
So 165 plus 20, 185. Where did the market sell off today? 185.
There you go.
That's just basic accounting arithmetic, right? So the producer who was holding on to butter did not want to sell when the market crashed because there's value in it. So they held on to it until the price went to a point where it was equitable for them to get rid of that butter.
Right.
So the behavior of what we are seeing in the marketplace, I mean, none of this, like I said, the only surprise to me was, and that was my surprise of my underestimation in the month of January of what the epidemic or pandemic, its impact on demand, and how we would completely shut down the economy. All of that was a surprise to me.
Right. I think it
The
was a surprise to everyone who knew.
No, I do see that. I do say that, but it's my job to be a step ahead, right?
Mm.
Because I advise people on risk management, so it's my job to be a step ahead. Um, and I will not get a lot of sympathy from my cohorts, except the fact that my cohort felt the same way. But that doesn't. There's no complacency. Can't take solace in complacency in that one. But these magnitudes of movement up or down is not a surprise to me at all. Now the question is, okay, so now we are seeing all this. What should the market participants do? And that, my view on that is no different than what we discussed 2-3 weeks ago, which is volatility gives us the opportunity to seek remedies for problems that we did not address in the first place. So if we felt $12 milk price was a price that a farmer could not survive on, well, we just got the gift in the last few days of price going up to 17.80. In fact, this morning it was $18 18.20 for Q3.
Yeah.
And that would have been great opportunities to lock in some pricing, because I would argue that people would have gone postal the first week of April to get an 18.50 price,
Oh my gosh, yes.
right? So we had 18.50 price yesterday. I didn't see many sellers in the market yesterday. So that's the anatomy in my mind of the market. The market is a reflection of people in it, right? Market's nothing but, a marketplace of buyers and sellers, and it's an order matching mechanism.
Right.
Right? There's a buy orders, there are sell orders. Market's always liquid. You may not like the price at which it is liquid. So price chases liquidity. Liquidity doesn't chase price. Liquidity is where a buyer or seller can agree on a price. That's really what we're seeing in the market today.
Okay.
So, it's not as baffling. It's not as baffling. What is baffling is other things, right? So now I'm sure, in another 2-3 months, we will learn a lot more about it, right? I don't put a lot of credence on this. And the reason I don't put a lot of credence on this is that, look, if I'm able to explain what happens in the market pretty mathematically meaning common sense basis, not mathematical, just common sense, arithmetic, accounting, then I don't think, there's a lot of credence to some of these things, right? It's a combination of many things. Like I said, there's probably a level of FOMO. There's probably a level of, this the government intervention program. So it's the intervention program is not the bearer of blame, but probably the parties to which those supply agreements were awarded to perhaps did not risk manage when they were bidding for that program. So let me give you an example. So when we would bid for an export contract to Japan, way before we would bid, we would go to the market, buy the futures, or buy some protection, some risk management in the marketplace to get a line of sight and some certainty. You can never get 100% certainty, but we would get some certainty in advance by buying the futures, let's say. Then we would buy the futures, and then based on the futures pricing that we were able to get, we would create a bid and we would offer it to the Japanese.
Okay.
So then when the Japanese accepted the price and accepted the contract, now I had to supply, right? Then I would go to the market to find the physical cheese that would be sent to Japan. But I didn't take a lot of price risk. Why? Because I'd already purchased, a price instrument or some risk management on price. But if I did not purchase it and I just went and blindly bid in the Japanese supply contract and Japan accepted, then all of a sudden now I have to go buy. And if I haven't bought something in the past and I go to the market and suddenly find out, hey, the market doesn't have anything to give me. Now, in order for me to keep my obligation to the Japanese export deal, I am willing to pay whatever price I have to pay here to procure the commodity and supply it.
Right.
So there's probably an element of that as well.
That's true. Right.
So as I said, what the market reflects is, very low levels of risk management in the physical business of producing, processing, and consuming dairy commodities. So this is somewhere where I would squarely say all of us as participants in the market need to take responsibility for what's happening in the action. This is not something you can point to some external party.
Yeah.
Which is, I think, the crux, of this discussion. And also, like I said, I saw prices at $18, $18.50, and I didn't see the nature of, sell side interest as I would have imagined, based on some of the conversations I was in late March, early April, in the industry,
Mm-hmm.
of en masse people in the supply chain hurting for $12.20, $12 price. I mean, you and I have had this discussion when the market was 1080,
Yeah.
right? And
Yeah.
and I had very feverishly said, I would like to say that we have tested the bottom at 110 cheese. And the reason I said I would like to say that is because 110 was when the market found buyers, right? So
Okay.
if the market has bought cheese at 110, next time the price goes to 120, there'll be buyers. And whoever is bought at 110 will buy again at 110. Right, so that's why I was feverishly saying, and I said, I'm sure famous last words, we found the bottom and the market will go down and test another bottom. But that's what I was saying, well, the market's found its bottom, but that doesn't mean the market screams higher, right?
Right.
Now, so if it does scream higher, and if anybody who was not risk managed, these are great opportunities to risk manage.
Oh, absolutely.
On everybody in the supply chain. Like for example, I think that's what the butter market is doing. They're doing a fantastic job of risk managing. 165 plus 20 cents, market went to 185, 195, and now you have sell side interest.
Yeah.
Now, what butter will do likely is every time it comes down to 165, sellers will stop selling, market will go up to 185, they will sell again. Now, it's not as easy as I make it sound. There's probably more to it than just that.
Well, people's emotions make it more complicated than just that.
Yeah, I know, absolutely. Absolutely. And that's what makes a market, right?
Absolutely.
That's what
Well,
makes it.
It's like you said, it's an opportunity. That's what we need to see it as
Absolutely.
to just commenting on the instability of it, focusing on how it can be utilized to our advantage.
Correct. Absolutely. So that's really, I think, the takeaway from this week.